Okay, welcome back, everyone. Today is Friday, January 23rd. I think it's been 2 weeks since my last video, but I'm going to give some updates, and I have an agenda here. So let's dive in. Again, I'm not a financial advisor, so anything I say is for entertainment and educational purposes only. Um, if you do need financial advice, please consult a professional. Um, yeah, so let's get going. If I go to Sorry, I go to my presentation screen here. It's a little small. Hopefully, you can see that. But basically, the agenda for today. The first thing I wanted to talk about, I wanted to do some research to see if there really truly is an advantage of income funds over growth funds. I know that there are two different types of investments. Obviously, one's income based or looking for income, one's looking for growth. But I wanted to see if there's an advantage of one over the other. So I've got a couple scenarios set up that I'm going to review. Second thing, I guess for number one, the factors to consider are the overall total return, which is better. Distributions, income. Obviously, if you're in retirement and you're looking for income, income is going to be better. If you're just trying to grow your portfolio and you don't need the income right now, then growth tends to be the advantage. Anyway, so I wanted to look at the differences there. Third, taxes. There's tax benefits, obviously, to deferring a lot of your income. So every distribution that you get will be taxed in some way. There's a caveat to that because of return on capital. And again, I'm not a tax professional, so I'm just going to tell you kind of what the things that I know, but do your own research for that. And then for maintenance, I don't think I spelled that right. That looks weird. Anyway, maintenance. What do you have to do to maintain your portfolio? With a growth portfolio, if you have to live off those funds, you have to sell every month or whenever you need income to live off of. So that can be a little bit of a pain. So I want to talk about that as a factor. Um, and then the third thing here, I want to do a comparison on stockanalysis.com, which gives a really nice overall total return chart for several different um, ETFs, funds, whatever you want to call them. And the total return then takes into account distributions as well as growth. So you can really get a good picture of the differences there. Um, Item four here, income is much larger for income funds. For retirement, this generates fairly stable income without touching holdings. So I just wanted to touch on this point, and I think we'll touch on it up above as we talk about it. But essentially, the whole reason for an income fund is it gives you income now, which down below here, I did a little comparison and said if you had a $300,000 portfolio, and you invested it in these five different ETFs with the most recent yield, divided evenly, you'd have a yearly income of 49,000 just from their distributions over the past year, if this holds constant or holds constant. If this holds steady over the basically what it's historically done. Um, and so it's like, well, on $300,000, $50,000, that's whatever that is, a sixth of the, so it's just under 20%, I think, total return, which is nice because you don't have to do anything. Again, you don't really have to, there's no maintenance there. So basically, when you're looking at that compared to, up here, I have SPYI versus SPY. For SPYI, you have an income of 33,000 versus SPY, it only gives you a $3,000 income from distributions. So where is the advantage of owning SPY? And well, because that's based on growth. So the distribution is lower, but you get growth in the stock price. So the return there is where you see the return. So it's just kind of a different way. Again, if you're interested in income versus growth. Anyway, I'm diving into the agenda too much detail. Sorry. Number five, we talked about taxes. Several of these offer a high rate of return on capital. We'll get into that in a minute. And then six, yeah, maintenance, what we already talked about. So let's dive in. So the advantage of income funds versus growth funds. I kind of already talked about it. But again, if we look at, I guess let's dive into the total returns here. If I can pull up this. So I've got SPY, QQQI, QQQ, and TSPY, and XPay here. So this is total return over the past year. And if you can see here, it's really uh, tracking very well. So SPY and QQQ are the Nasdaq and S&P tracking ETFs. So if we look at, as of whatever this is, yesterday, the returns here for SPY are 15.59%, and SPYI is 15.07%. So it's very close total returns, which you would kind of expect because that's the point. This SPYI and QQQI are income based, or they're trying to generate as much income versus just you know versus stock price return growth, and they're doing that to generate income for you so that you don't have to do the maintenance of, if you own QQQ, like I said, every month you'd have to sell that. So you can see they're tracking very well. Same with the Qs and QI, 16.9% versus 18.88. So you see a little advantage in SPY and the Qs, overall total return. Some of that is maintenance, probably. Some of that is just inconsistent or inefficiencies of those stocks to generate that income. And there's cost doing that as well. So, and then, but yeah, you see, sorry, I keep moving. You see XPay and TSPY as well. TSPY is TAP Alpha, I believe, who manages that, and XPay is Roundtail. Sorry, but honestly, they're popular options. But you can see here that they're tracking very closely as well to the overall market. Um, so I think if you look at the total return here, you know, I don't think there's much of an advantage looking at this over either, because even in April when we had that huge dip, the Qs was actually down the most, more than QQQI, and SPY was down more than SPYI as well. That's because they generate some income even when the market's going down. But obviously, when the market recovered, then you see the opposite picture. So it's a little more maybe buffered, is what I would say. But yeah, it's tracking very closely. Now, if we change this to price change, so this is just the percentage change in the stock price, you see up here, the green and the blue here are the Qs and SPY. Huge gains overall in price change throughout or over the past year, versus everything else is fairly flat. Now XPay is down a little bit, 7%, but everything else is pretty much flat over the year. And it took a big dip, but then it was obviously much harder for it to recover and come back versus the Qs and SPYs. Qs and SPY did recover quite well. So the price change, you can see the difference there of a regular tracking ETF like the Qs and SPY versus the income-based ones. Their overall price, stock price, ETF price, whatever you want to call it, holding price, um, did not change very much. But why the total price is the same is because they're giving out distributions. They're generating income for you. So anyway, I thought that was an interesting comparison here. Not much else to look at, but overall, they're tracking very closely. And part of that reason is the fact that they the funds that they SPYI and QQQI hold are very similar to what SPY and QQQ hold as well. They're the larger names, but they just write, covered call. They generate income through covered call writing, or whatever, to generate the income. So it makes sense why they would kind of track very, very similar. When I was doing so what I've got here is, again, a pretty messy spreadsheet, but I was trying to compare SPY versus SPYI and say, okay, for this particular one, if we had an investment of $100,000 and we had, let's say, $1,000 every month we wanted to take out, historically over the past year, from January 1, 2025 to December 2025, how would that, what would that look like at the end? So this is all historical data. Hopefully it's accurate, but again, don't use this as advice. This is more just informational for you to go out and do your research. So if you look at the total return here, we'll see that SPY had a total return of 5% and SPYI had a return of 4%, which again, this is the total return doesn't include the distributions. It's including, or it's taking out, I guess, $1,000. So if we were to change this to 0, we would see very similar to what we saw on the stock analysis chart. So if we reinvested everything, all of the distributions, didn't withdraw anything, we'd have a 15.7 versus 14.8 total return, which again, so very close. But now, if you needed to take out $1,000 every month, let's say, um, I have share delta here, which this is how many shares would have to be sold of the underlying stock of SPY for you to cover that cost to generate that income for you. Because again, SPY doesn't, they have a dividend, but it's $1.80 per share and it's only quarterly. So I took that into account, obviously, as well. So that $300, you have to sell less shares to generate that $1,000. On the SPYI side, you're getting a much larger dividend, 0.51 cents. And again, this is average dividend here. I um, I think it ranged from 0.49 to 0.53, something like that. I just did an average to keep it simple. Um, so, but basically, yeah, if you started with 1970.1 shares, this is how much dividend you would get from that. And then because I'm only withdrawing $1,000 every month, this covers that, and I basically don't need to sell anything. So that's how this calculation works, and it takes the last value, runs the numbers, does all of that. So again, if we say, okay, zero, you don't take out any money and you reinvest everything. Okay, well, at the end of a year, last year, your $100,000 would be worth 118,696. Long story short, if you withdraw anything out of this, total return here 18% versus 17%. It's pretty close, but obviously there's a little bit of a gain or a little bit of a higher return on the SPY, which again, as a growth fund, that's great. Um, let's see. So, and you would accumulate, you know, roughly half of a share every dividend. So you'd end up with 172.5 shares, or uh, you started with 171 and you'd end up with 172.5. So not a lot of growth there as far as shares. You get all your growth in the stock price. And as you can see, the stock price goes from 584 to 687. Um, so on the SPY front, though, you see the difference of you started with 1970 shares and you ended up with 2,221 shares. Again, reinvesting all of those dividends because you're not pulling anything out. So all of that gets reinvested. So you ended up with quite a few more shares, 229 more shares than you previously had, which yeah, I mean that's pretty cool to see those shares go up, and the stock price even increased slightly too, but again, not nearly as much as over here on the SPY side. Um, so you're seeing your income increase because you started with 1,000 and now you're down, or now you're getting 1,100 just because those added shares, and your overall return 17. Okay, so now if we were to say, okay, let's take out let's say $1,000 and say we want to take out $1,000 every single month for living expenses because we're retired. Well, now you see that the shares of SPY, you have to sell one point, however many, almost one and a half shares every month to cover the cost of that $1,000 because your dividends are not paying that much. So you see your shares go from 171 down to 153. Now the overall return is still somewhat positive. Again, this is saying the current value. What is the return? Um, so you've already taken out $1,000, so that's not included in this. Even though that's technically part of the total return, this is like kind of the current value. So maybe I should have called that there. But anyway, the trouble with this is you're selling your shares, even though they're worth more. You're saying I had 171 shares and now I only have 153. And eventually, after however many years, those shares are going to keep going down unless you rebuy in, unless you put more money back into it to keep building those up. Now, maybe it's not a big deal. Again, this will take at this pace 20. It'll take whatever 30 years to completely deplete this. But if the stock price doesn't keep increasing or going up, or the dividend goes down, or something else, well, that could become more of a factor. Um, and then here we see on the SPY side, the shares pretty much stay the same because we're getting paid about that in distribution, what we need each month. So you see that's fairly consistent. The shares are fairly consistent. The overall return, the current value is right around the same as what it is with SPY. But yeah, all of that money came from all of your monthly expenses were paid for from the distribution versus over here you had to sell stock to basically get that money. And that was, one of the points here that I was making about the maintenance. For the SPY-I and these high income ETFs, basically there's not a lot of maintenance. You basically get that distribution, every month without having to buy or sell, or well, I guess sell stock to cover that cost to generate income for you. So maybe that's not a big deal. You have to figure that out. Um, Now, if we went, let's say, $2,000 more, um, now we see the similar thing happening with SPY-I. We had 1970 shares. Now we had 17. Now at the end, after a year, we have 1,721. So we lost 227 shares. And on the SPY side, we lost 37 shares, roughly. Um, so, if it seems like if you're buying an income ETF for the income, that you really, and I guess this is putting all of your, eggs in one basket, but if you're trying to generate enough income in SPY-I, for example, or anything else, that uh, that you want to cover the expenses, it seems like if you want to withdraw more than it's generating, that the income ETF doesn't really provide a ton of value because you're still losing shares here, and just like you are on the growth side. But again, you don't have the maintenance, so maybe that's something that's okay. Um, anyway, thought that was an interesting comparison. I was kind of expecting it to be a little more beneficial on the income side, to be honest. But looking at that stock analysis chart, you can see that the total return is very comparable. So, you would expect, well, I'm getting a lot of income, but the stock price is not appreciating. It's basically flat or hardly going up. Versus on the growth side, the SPY stock is actually appreciating quite a bit. So it's not giving the distributions, but it is still appreciating in value. Um, so let me see. What haven't I touched on here? Sorry, I kind of jumped all over in this, but oh, again, I just wanted to highlight for Investopedia, return of capital reduces an investor's cost basis and is not considered capital gains from the investment. Not taxable until the cost basis is reduced to zero, at which point any subsequent return will be taxed as a capital gain. So from Investopedia, basically it says if you're investing 60,000 into this, into SPY-I, for example, and it gives back 100% return on capital, that means if it gives out, pays out $1,000 a month, it'll take 60 months of payments to basically reduce your cost basis down to zero before you would start getting taxed for that. So that is an advantage versus a normal distribution or a normal dividend that gets taxed at your regular rate. Which again, I'm not a tax expert, but that's the way that I understand it. So do your research on that if you're interested in that. Let's see, quick market update, quick portfolio update, I should say. Um, as of right now, it's 342, down, a few $100s, but really the market for the past, I don't know, feels like a couple months has been fairly flat. So this is okay. The market return is down $4,000, but I have received, quite a few, almost $4,000 in dividends. Um, so that's where it's even. Now, again, the hope is that, if you look at the shares, the difference here, you can see that all of these TSYY, for example, I started with 200 shares. Now I have 291 shares. So if the market the market starts going back up, excuse me, um, hopefully every percentage it goes up now, I'm getting more distributions from that. I'm getting higher distributions, I guess, because I now have a more, third more, I don't know, 130% of what I had before. Is that right? 200, now it's 300. I don't know, whatever. I'm getting significantly more each payout. I'm getting 91.6 shares more of that distribution. And several of them obviously have been going up because that's kind of the plan, is all of this is being reinvested. um, so we'll see the market. I mean, who knows what it's going to do this year. I don't, many people don't, but Again, I'm still tracking everything. Distributions here seem like I'm missing some for this week yet. So hopefully those will come in here, but all of my weeklies should be paying me shortly, and those will show up here. Yeah, anyway, let me know what you think about this analysis here. If I messed up any other numbers, or if I'm missing some major point or advantage of SPY versus SPY I. Yeah, let me know your thoughts, and let's chat. Thanks.